Hello, everyone. Welcome back to Structurally Speaking, a Hildene Capital Management podcast series. I'm Jason Schechter, your host and head of capital markets at Hildene. Today, we'll be talking about collateralized loan obligations, better known as CLOs, a topic I know a lot about. For a brief overview on the basics of CLOs, please visit our HCM Academy video, an introduction to CLOs, found on the Hildene website. To facilitate this discussion, I would like to welcome Brett Jefferson, the founder and Co-CIO of Hildene Capital, to the podcast. Thanks for joining us on our third podcast in Structurally Speaking. I feel like a pro now, but I'm looking forward to this podcast more than the others because, as I mentioned a little bit before, this is an area I really know and I love talking about this.
Sounds great. Thanks for having me again.
As I was preparing for this conversation, I was thinking about it the other night. Do you realize that between us, we have over 60 years of CLO experience? And when Dushyant joins us a little bit later, it's close to 80 years of CLO experience.
Well, that's something. You and I are like the two old guys in the Muppets, right? So we've been around forever, and we've seen a lot of things change. You know, in looking back on our time when we first met, what was that, 2003? I can't think of anyone who's still around doing this. I mean, we must not be able to find anything better to do with our time.
Very few people, very few people. But it's been a wild ride, enjoyable. So although we're really going to go into what's happening today, can you explain just very briefly what is a CLO?
Well, a CLO is in essence a standalone finance company, similar to a bank. You have assets and liabilities. With a bank, you need to have equity, and that equity, is similar to CLO equity, where it gets all of the residual value. The assets, in this case, are non-investment grade, for the most part, broadly syndicated leverage loans. And your liabilities are everything from AAA financing down to BB financing. So in essence, it's a standalone finance company with its own rules, which are known as an indenture, which let's just say that has changed dramatically throughout the years as to making this product more efficient, but not efficient.
So that's interesting that you said that. So let's take this market in different steps. I know the nomenclature out there is 1.0, 2.0. And for those people who don't know, 1.0 is pre-Great Financial Crisis, 2.0 is post-Great Financial Crisis. But also for people who don't know, in the mid-2000s and after this crisis hits, all you hear is CLOs, never touching them again, worst asset class, massive amounts of defaults. We know now that's completely untrue. Can you talk about why people think that this market didn't perform as well as it did, and what actually the truth is that it performed better than people expected, and a little bit more about why did it perform so well?
Okay, a lot there. So we need to talk about fundamentals and technicals. So from a technical standpoint, like every structured product, whether it be TRUPS, mortgages, CMBS, CLOs also had volatility. And it really occurred in one instance, really over a few months, because a lot of banks ended up either having this on their balance sheet, different parts of CLOs, or they ended up acquiring them through different workout situations. There was a massive sell-off in the market. I mean, there were times when you could have bought equity for literally nothing, for a couple bucks, kind of like we were buying TRUPS. And it did perform. What did happen, though, which was so unique, was there was a lot of refis. Everyone looked to refi. And the performance of the equity on 1.0, which stayed outstanding for a very long time because there was no new issue market, was phenomenal. But it wasn't smooth sailing. It was a bumpy road. There were a lot of hiccups. But if you were buying 1.0 equity anywhere from 2012 to 2015, that was a great trade. And it was a great trade just because of the extension that occurred within this product. That just is sort of like a bank being able to lock in their financing levels and then all of a sudden being able to go take advantage of assets when they widen out. Usually it doesn't work like that, but in this instance it did.
Even with that outperformance, the 1.0 CLO structure and the 2.0 CLO structure are different. If they perform so well, why are the 2.0 structures even better?
Well, there's less leverage in the 2.0. There's more, let's just say, protective mechanisms which allow people to not game the system. Haircuts for triple Cs, haircuts for deep discounted sales, just more protective aspects of the structure. What really happened was the market got smarter. The market could demand more. It became the buyers of this, and especially at the highest level in the AAA, because a lot of these were still being bought by banks, really had to make sure they were getting a protective structure. So they really started to drive this. What also happened in the 1.0 market was different banks would issue with different just nuances within the indentures. And you would have to understand what those different nuances were. Sometimes you could really take advantage of those. The market has become way more uniform. Managers will get, rated, or when I say rated, will be viewed in the market. And if you're not a good manager, and we have different opinions on a good manager to us and a good manager to somebody else, that varies. But if you do not perform well, you'll have a hard time growing your business.
We discussed equity tranches. At Hildene, we also imbibe some of the mezz. How have you seen mezzanine tranches change? And do you always buy mezzanine of the deals you buy equity for, or do you look at it differently?
I would say we definitely look at it differently. There are times when buying, let's just say, the double B tranche and buying the equity makes sense because you may call a deal and make nothing on the equity, but the double Bs you bought at 85 and you're going to make 15 points on that call. That's understanding that option and understanding how to take advantage of it. Mezzanine tranches have become much more robust. The triggers have become much better in these deals. The ability to address issues quicker have become, made these mezzanine tranches safer. So we really haven't seen, if any, impairment at all in this asset class. Whereas there have been a lot of investment grade companies which have become fallen angels and then have fallen even further. So
based on that, I have a statistic that says in 2.0 CLO land, no triple B has ever experienced a loss, and less than 0.5% of the double B market since 2009 has experienced any loss. And I don't mean full loss, even a partial loss. With that kind of track record, why do you see still not as many people in this market class as there are in other structured product asset classes?
Your question is why don't more people get into this product? I would say the learning curve, the complexity, it's a different mindset than looking at individual credits. It's funny, I've met a lot of people who have tried to, let's just say, be tourists in this market. Right. There's a big learning curve. There's a lot of infrastructure. And the way you would look at one credit is very different than the way you would look at, 100 credits that are in a securitization. We're looking at a securitization and saying, okay, we're going to take the market's word for it and say that loan that's trading at 98 is good. And there will be some that won't work out, but are we being compensated well for that risk? If you try and go through and break down every single credit in a CLO, you'll never get anything done. So you're really looking at how much loss can I take before I have impairment. That's why buying something that's, anywhere from 1.5 to 3 years, it gives you a real visibility into what are the issues. Is it an industry issue or is it a credit issue? And you can really start to understand how that is being perceived.
That's great. Listen, I appreciate this, and we're going to talk with Dushyant a little bit later about some of these structural implications that we look at here, and then Jatin is going to join us to talk about some of the technology that we've looked at.
Well, that's great.
So
great.
Appreciate you coming in this time.
Thank you very much, Jason. Always a pleasure.
For our next segment of this podcast, I'd like to welcome into the room Dushyant Mehra, our Co-CIO, and Alex Cowen, our CLO trader.
Hi, Alex, and welcome. I believe this is your first appearance on Structurally Speaking.
It is. Thanks, Dushyant. It's good to be here. I really wanted to do this because I think the audience would benefit a lot from your perspective, specifically on Hildene's unique approach to CLO investing. When I arrived at Hildene, I already had some CLO experience, and I remember being blown away by our unique approach. Specifically, I remember in some of my first days here, looking at a piece of CLO equity and quoting NAV to you, and immediately you popped up and asked, why does that matter? And I think that question really captures what makes our approach unique, different, and effective. So I'll stop talking because I think the audience really wants to hear from you. So to start, what is your background and how did that inform your approach to CLO investing?
Well, sure. So I started pre-GFC my career on Wall Street at BofA's CDO structuring desk. And then post-GFC, I spent time at a few buy-side firms investing in all forms of structured credit, but non-agency RMBS, and then in particular IOs or interest-only bonds of RMBS. And so when I was first introduced to CLO equity back in 2010, I think I had a unique perspective. My experience in the CDO structuring desk equipped me well to quickly come to speed with the structural nuances and the documentation within the CLO. And then my background in looking at IOs really gave me a very differentiated valuation approach for CLO equity.
Can you elaborate on that valuation approach? Is there a framework to it?
There is. So really at a 10,000 foot view, right? CLO equity has two components to it. There's the principal component and there's the cash flow or IO component to it. The principal component is multiple years away when the CLO equity gets paid back its principal. And it is a 10x levered exposure to high yield loans or losses on high yield loans. The IO, however, is a quarterly cash flow that is imminent and as a result more predictable. So really what it comes down to is focusing and understanding the nuances embedded within the structure that enhances that IO, right? So examples would be in underlying loans have LIBOR floors, and typically they're at 1%. So when rates are at zero, which they were in 2010, that's a big part of the valuation process because you're getting 1% extra on the underlying collateral that you're not paying out for your cost of debt, 10 times levered to the CLO equity. And that reminded me of inverse IOs in the resi space. There are a few other examples would be refinancing of the CLO debt stack, which reduces your cost of debt and as a result increases the excess spread available to the CLO equity. And then lastly, but I think most important, is understanding how a CLO manager plays into the valuation process of CLOs. Managers who have the ability and most importantly, the incentive to keep CLO equity cash flowing will understand the nuances of how to keep the deal invested post-reinvest, the end of the reinvestment period, or trade the portfolio in a way that can affect the cushions they have on cash flow triggers or OC triggers.
Fascinating. And when in different market environments, the probabilities change. So could you just elaborate a little bit more for the audience on how those things change in those different environments?
Yeah, so to be clear, the market cycles don't change our valuation approach. What they change is the probabilities that we assign to each of those events, which in turn enable us to or prompt us to take various different actions in different market cycles. So I'll bring up a chart. The x-axis is the liability spreads. The y-axis is loan prices. And in most market cycles, those events, liabilities and assets will move in tandem, at least in the medium term. But in short cycles, they can move in opposite directions. So all four quadrants of this chart are possible at different times. If I had to break this chart down, let's just focus on the top half of the chart. When loan prices are high, you want to be reducing credit exposure, you want to be reducing risk. You can really do that in two ways. If liabilities are also tight, you will probably refinance the capital structure and reduce the cost of financing, and as a result, increase excess spread. If liabilities are wide and have not followed asset prices, you're probably looking to call the deal and realize that deal. Conversely, on the flip side, when asset prices are low, which is the bottom half of this chart, you are focusing on adding risk. And you can probably add risk both in the new issue market, if liability prices are there and CLO arbitrage makes sense, or you focus on the secondary market, on bonds that were originated in prior cycles, and you're looking for cheapness in the secondary market.
Makes sense. So, final question, where do you think we are in the market today?
Give some historical context here. I think in the last 2 years, we've kind of been in the top half of this chart, right? Asset prices have been up, and the market has generally been focused on calls, refis, and resets, and reducing risk. Now, in the last, I would say, a month or so, the macro volatility has led to asset prices or loan prices being lower. And depending on your view on cheapness of those loan prices, you can either add risk on this primary side, if liabilities are there to be had, or the volatility is creating opportunities on the secondaries market as well.
Awesome. Thank you, Dushyant. Appreciate you taking the time to talk about this with me today. I think the audience will find our approach to CLO investing super helpful. Thanks again.
Thanks, Alex.
For the last segment of this podcast, I'd like to welcome into the room Jatin Dewanwala, our head of research, and again, Alex Cowen, the CLO trader, to talk about technology.
Hey, Jatin. Thanks for joining me today for this conversation about CLOver.
Well, great to be here, Alex.
Tell us a little bit about your background and how you parlayed a non-CLO investing background into building what I think is one of the best CLO analytics platforms out there.
You are right. I am not from the world of CLOs, but I have been in the world of structured products for 20 years, and I'm a financial engineer by background. In fact, my first job was pre-crisis, looking at agency hybrid arms and investing in them. And before you knew it, the crisis hit, and one day my then boss turns to me and says, start trading option arms and subprime. I'm like, wait a minute, I don't know anything about them. And we were a very small team. We were all of 5 people, including ops, marketing, accounting. So if you kind of wanted to look at anything, you kind of had to do everything on your own. There weren't any resources that were available. So that meant doing the research, doing the modeling, buying the bonds, managing the portfolio. Everything had to be done by me, which was a great experience. I was young, and it was almost baptism by fire, especially with the wildness which was going on at that time. But it taught me a lot. And that did a world of good to me, because before I knew it, I was jumping into ABS and then looking at specialty finance plays, including monoline insurers. And the longer you do it, one thing you realize is that while every investment has its own nuances, they have a lot of commonalities to them. There are a lot of similarities. And if you think about it, every investment is about money in and money out, right? And if you can simplify the components and bring it down to a level where you can just understand how the cash flows behave and operate, you have an edge. And if you think about what we do at Hildene, we're really good at that. Because while we traffic in very complicated products, we try and take a very simple approach. We try and break it down, look at the different components, and then come up with an assessment of value.
Makes sense. And so then how do you apply that philosophy to building the CLO investing platform, to really building out CLOver?
CLOs are an interesting asset class in the sense that they're not just a structured product, but a structured product plus a fund, right? There's a CLO manager, as you know, who's kind of calling the shots of buying collateral, selling collateral. So there are fund-like components to it, and there are structured products-like components to it too. And especially for a CLO equity investor, which is one of our big specialties here within the Hildene team, it's very important to use that lens and analyze, how a CLO will behave, because there are incentives in place, right? And our analytics system, which you know is called CLOver, is kind of geared towards figuring out those nuances and finding pockets of value trapped inside the CLO structure, which will all accrue to the benefit of the CLO equity, right? So there is a module in there to figure out if there are any mispriced assets inside the CLO pool. That could be not accounting for accrued interest properly. That could be, missing the value of reorg equity, or it could be documentational nuances, right? Like what are the manager's abilities and rights at the end of the reinvestment period? Or it could be structural nuances, right? Where is the interest diversion test structured with respect to the tranches and with respect to the other triggers? Or it could be, simply like the optionality that is trapped inside the structure, because you may buy a CLO with a certain, liability spread on it, but you could refi or reset it, which would just unlock more value to the CLO equity. And then finally, there's the manager, right? How has the manager performed? What is their track record of, adding value to the CLO and to the CLO equity? Are they making the right trading decisions? How good are they on credit selection? So CLOver tries to address all of these different questions.
What's an example of how those analytics and modules added value during that time in that COVID craziness?
Yeah, so one of the examples that comes to mind is, and it goes back to what the rating agencies were doing at that time, right? So if you recall, rating agencies were very proactive in downgrading broadly syndicated loans at that time. And their thought process was that, look, COVID is a big, call it tail event, which is taking place. Losses can go up a lot, and we need to get ahead of it and then start downgrading these loans. And the way that CLOs work, there are CCC bucket-related tests which shut off cash flows to the junior tranches, right? And as you can imagine, if you're doing this mass wave of downgrades, being a rating agency, more and more of these loans are transitioning into the CCC buckets. And because of that, your buckets are swelling up and these triggers are failing. And as you know, like CLOs have this allowance of 7.5%, where if your CCC and below rated assets are less than 7.5%, you get par credit for those assets. If not, then the lowest dollar price assets start getting carried at market value. And that can be huge, right? Because if they're within that 7.5% tolerance, you're getting par credit for them. Otherwise, they could be trading at 40, 50 cents on the dollar, and you're carrying them at that, right? So that haircut which gets generated by that different treatment of value leads to you failing your triggers, right? And again, these weren't real losses which were taking place. This was just a mark-to-market phenomenon, right? And on the back end of COVID, where we knew that, look, the worst part is behind us, and really, things should be on the mend, there was still a massive amount of dispersion within the universe of CLOs, right? Where triggers were failing, and the real challenge was figuring out which deals will cure their triggers faster than the others.
Right.
Right? And what we did was we wrote code, analyzed all collateral and all the different 1,500 CLOs which were outstanding to come up with, look, these are the different assets which make up the CCC bucket. And if the managers took certain actions, like for instance, selling $80 price and above CCC loans to make space for the 50 cents on the dollar loans to sneak into that 7.5% bucket. That would just cause those triggers to cure, which would then mean that CLO equity cash flows, which are today shut off for that given deal, would turn back on, right? Yeah. And the market at that time was not anticipating that these actions in a given time frame with a high degree of probability will occur, because the manager is incentivized to take those actions, and the CLO equity pieces would start to cash flow. So we were able to pick up a lot of these QSIPs at deep discounts to what their intrinsic value was, and that was a big reason why we had a pretty strong second half to 2020.
Yeah, it's really fascinating, and you can really easily see how a tool like that and a functionality like that would add a lot of value in a time where it wasn't really clear where things were going.
Exactly.
This was great, Jatin. Thanks for jumping back on the pod.
Yeah.